In early 2025, the Trump administration doubled down on tariffs, aiming to protect American industries from what it called unfair foreign competition and to restore the nation's manufacturing might. The hope was to bring jobs back home, revitalize struggling factories, and spark a new era of American industrial growth. The new plan targeted key sectors: automobiles, pharmaceuticals, and semiconductors, with aggressive new taxes on imports, especially from China, the world's largest exporter. A potential 25% tariff on foreign cars sent shockwaves through the global auto industry, threatening to raise prices for American consumers and disrupt established supply chains. Meanwhile, similar levies on medicines raised fears about shortages and higher costs for life-saving drugs. And new tariffs on microchips threatened to disrupt the delicate web of global electronics manufacturing, putting American tech companies at risk. Supporters called it a bold correction to decades of unfair trade, arguing that it was time for America to stand up for itself. But the risks were enormous, and critics warned of unintended consequences. The administration assumed global companies would simply adapt, shifting production to the US, but overlooked how easily capital and operations move in today's interconnected world. Instead of building an economic fortress, the US risked isolating itself, as the world's supply chains and financial flows moved on without it. The global financial community reacted with alarm, not compliance, as uncertainty rippled through markets from New York to Tokyo. Investors and corporations saw the tariffs as a source of volatility and risk, not strength, and began to question the stability of the American market. Rather than investing more in America, they began looking for exits, moving money and operations to friendlier shores. This set the stage for a massive flight of capital, led by the world's most powerful financial players, who saw opportunity elsewhere. The grand gamble was about to be tested, and the early results were deeply troubling, casting a long shadow over America's economic future. The world's largest investment firms, BlackRock, Vanguard, Fidelity, manage trillions of dollars and shape the fate of global markets. Their decisions ripple across continents, influencing everything from retirement accounts to the stability of entire economies. When the new tariffs hit, these Wall Street titans faced a dilemma. Should they protect their clients' money or remain loyal to US markets even as risks mounted? The stakes were enormous, and every move was scrutinized by investors worldwide. The tariffs increased costs for American companies, squeezed profits, and invited swift retaliation from trading partners abroad. Suddenly, the landscape for US businesses and investors became far more uncertain. Suddenly, US assets looked riskier than ever before. The sense of stability that once defined American markets began to erode. The fund managers decided it was time to diversify, to shield their portfolios from the growing storm. They began a deliberate, methodical shift, reducing holdings in US stocks and bonds, and increasing investments in more stable European and Asian markets. This was not a hasty move, but a carefully calculated strategy to protect their clients' wealth. This was a quiet but powerful vote of no confidence in US economic policy, a message sent not with words, but with billions of dollars. Publicly, the firms criticized the tariffs for creating uncertainty and harming global trade. Behind closed doors, their strategies shifted rapidly. Privately, their actions spoke louder. Billions were quietly moved out of the US market, seeking safer ground overseas. The message was clear: America's protectionist turn made it a less reliable place to invest, shaking the confidence of even its most loyal backers. This retreat by the stewards of American capital was one of the first unmistakable signs that the tariff policy was backfiring. Instead of hurting foreign competitors, it was damaging confidence in the US economy itself, with consequences reaching far beyond Wall Street. The ripple effects were immediate and impossible to ignore. Other investors took notice, accelerating the outflow. The world was watching, and confidence was contagious, both in its rise and its fall. The foundation of American financial strength was beginning to crack, sending shockwaves through the global economy. BlackRock and Vanguard, two titans of global finance managing over $10 trillion in assets, had long relied on the US market as their anchor, a foundation of stability and growth for decades. But the escalating trade war's volatility forced a dramatic rethink of their strategies, shaking the confidence that once seemed unbreakable. Rising inflation, persistent supply chain disruptions, and slowing economic growth made US investments less attractive than ever before. The ripple effects were felt across industries, from manufacturing to retail. These financial giants began systematically reducing their US equity allocations, Shifting even 10% of their portfolios meant hundreds of billions of dollars quietly leaving American markets, a move that sent shockwaves through Wall Street. That capital didn't just disappear, it flowed into European blue chips and emerging Asian markets, fueling growth and optimism abroad. The move was a direct response to the new tariffs as American companies faced mounting headwinds, higher costs, unpredictable supply chains, and shrinking profit margins. Apple, for example, saw costs rise sharply. Automakers faced retaliatory tariffs that threatened their global competitiveness and forced them to reconsider their own supply chains. For BlackRock and Vanguard, staying heavily invested in these vulnerable sectors was simply too risky. Their analysts pored over data, searching for safer havens. Their duty to clients demanded more stable returns elsewhere, prompting a global rebalancing of portfolios and a search for new opportunities. The exodus increased U.S. market volatility and sent a clear message: if America's biggest funds are diversifying, others should too. The sense of urgency spread quickly. A domino effect began, with global investors following suit, accelerating the outflow of capital from the U.S. and amplifying the impact. In a globalized world, capital is fluid. It flows where it's treated best, and investors are quick to adapt to new realities. The new tariff regime made the U.S. less hospitable for investment, eroding its reputation as a safe haven. The steady support of these giants was fading, leaving a void that would be difficult to fill. The consequences for American markets were profound, marking the beginning of a new era of uncertainty and global realignment. International investors responded even more dramatically. The China Investment Corporation (CIC), managing over $1 trillion, had long invested heavily in the U.S., but the trade war and anti-China rhetoric changed everything. The U.S. was no longer a safe place for Chinese capital. Facing regulatory scrutiny and tariff threats, the CIC began a systematic withdrawal. This was a decisive break, not a subtle shift. The CIC pulled back from U.S. private equity and divested from public companies. The move was both financial and geopolitical, protecting China's assets and reducing dependence on the U.S. dollar. The departure of a state-level investor like CIC sent a chilling signal. The world's second-largest economy was steering its wealth away from America. This loss of capital meant less funding for U.S. businesses and a weaker financial ecosystem. The tariffs, meant to protect, instead provoked a damaging backlash. The financial ties between the two superpowers were unraveling. The tariffs didn't just shake Wall Street, they hit American industry at its core. Multinationals like Apple, Tesla, and General Electric faced higher costs and uncertainty. Instead of expanding in the U.S., they looked overseas. Apple ramped up production in Vietnam and India, not America. Tesla expanded in Europe and Asia, putting U.S. plans on hold. The tariffs, meant to boost U.S. manufacturing, pushed companies to invest abroad. High-skilled jobs and innovation followed. The U.S. was losing its edge as a destination for growth. The capital flight and corporate migration sent shockwaves through the U.S. economy. Stock markets turned volatile as major funds and foreign investors pulled out. The Dow and S&P faltered, hitting retirement savings for millions. Hundreds of billions in investment vanished, money that could have fueled new businesses and innovation. Economic forecasts were revised downward, growth slowed, recovery stalled. The tariffs failed to strengthen manufacturing. Instead, they raised costs and hurt competitiveness. U.S. manufacturers, reliant on imported materials, struggled to compete. The Chamber of Commerce warned of long-term damage and isolation. The policy created more problems than it solved. America's economic ties to the world were being severed, weakening the nation from within. For ordinary Americans, the pain was immediate. Tariffs are taxes, and consumers paid the price. Electronics, appliances, even groceries cost more. A 25% tariff on cars meant thousands more for new vehicles, hitting working families hard. The promised manufacturing boom never arrived. Instead, layoffs spread across the Midwest. Farmers lost access to key export markets, incomes fell, bankruptcies rose. Manufacturers facing higher costs and shrinking markets cut jobs to survive. The result: rising prices, stagnant wages, and economic insecurity. The tariffs, meant to help workers, left many worse off. The human cost of the trade war was undeniable. As the economic pain deepened, public anger erupted. Protests swept major cities. Workers, farmers, and families united against the tariffs. Demonstrators decried rising costs and job losses, demanding change. The political backlash was fierce. Democrats condemned the tariffs, while even some Republicans broke ranks. Congressional hearings amplified stories of hardship and economic damage. The administration, however, remained defiant, insisting the pain was temporary. The tariff debate became a flashpoint in America's culture war, deepening divisions. Economic policy was now a battleground for the nation's future. The events of 2024 and 2025 revealed the fragility of America's economic position. The tariff strategy, meant to show strength, triggered capital flight, corporate migration, and global retaliation. Instead of a manufacturing renaissance, the U.S. faced lost jobs, innovation, and growth. The dollar's dominance and America's economic leadership were at risk. Without a course correction, the nation faced slower growth and diminished influence. The lesson was clear: economic walls are no substitute for true competitiveness. America's future depends on rebuilding trust, stability, and global engagement. The cost of isolation was becoming painfully clear.